In the last few lessons, in the last few posts, I wrote about mapping markets, structuring markets, so we can come in here and be able to read a market, connect to a market. We spoke about mapping them with swings, and we spoke about mapping them with gaps. And so this is this week's yen. This is what we came into looking at the yen during our session on Monday. So this was the yen for the week. And it's a beautiful example where we can begin to combine both and see how price interacted from these points, and learn to even use our tools rather than be used by them. These are not complicated methods, but this is still not easy. Trading's a difficult thing, and it takes some practice. So we start here. The basic place we're going to start is mapping our major swings. Go back to the previous lesson. It's basically a new high confirms a new low, and the largest swing is going to be the largest reaction leg on the board. So for instance, both of these are swings. So we have a new high, confirms a swing low. We have a new high, confirms a swing low. We're going to make the distinction of minor and major. Major is going to be the largest reaction leg, and minor is going to be the next largest. So you come in here and you map. And just look at the size of the reaction leg. This reaction leg is about this big. This one's about this big. So here we have major, right? This is a swing, right? It's a swing. It's completing a cycle. This is a swing, and minor swings. And so that's mapping a market via swings. And you can get an idea of what went on in this market, right? If you followed it down, it was going down. It was going down about yay big, right? About yay big. Draw a median line, you can see it was going down about yay big, and now it's not doing that anymore. It made a turn. Okay, so let's also now look at gaps. So coming into Sunday, right, this is the Sunday open. We define a gap as a wide range bar bigger than the last three bars, and that's in a previous lesson. And so you can see this is the biggest, baddest gap on the board going down. It's nothing else like this. And the way we map this is we're just going to grab the upper third of the gap and make observations. So you can see we gap down, we ran back into it, and now we're heading down again, right? Price is heading for new lows, is trying. So that's a down gap. If you look, we also have an up gap. Remember, we're just mapping. Okay? This is what I want to get across. We're just structuring at this point. So notice, with just structuring gaps, what do we have? We have a down gap that's holding, and we have an up gap that's holding in this 20-minute yen. So this is a bit of pressure analysis. Just these two boxes we can begin to read and ask questions. Who's going to win, right? We can see the sellers hit. We can see the buyers hit and bounced, right? Who's going to make new highs or lows? And so with this kind of analysis, at some point, price will tell us if we're listening, right? See, it's testing these sellers. It's testing these sellers. Zoom, it blasts them. Right here, it's easy. We know who won this battle via gaps. So that was analyzing a market via gaps. This is analyzing a market via swings. And this is our major swing. So this eliminates a lot of the noise that goes on in the market. So what we're doing when we're looking at swings, I'm just seeing basically waves. That's it. Just seeing waves. or we can just do it seeing gaps. And it's important to start to weed things out. So I'm not teaching a setup here or a statistic. We learned who won, and the nature of swings are to swing. If you ever notice and you look at any chart, you'll see new high, everybody gets excited, it pulls back. Everybody gets upset. New high, everybody gets excited, it pulls back. Everybody gets upset. Alright, so from here we can make projections, right? Just simple measured move type projections. And even here, if you wanted to, we can use gaps, but let's not complicate it. And so as price comes down, all nice and ugly, you can make observations down here. And so don't complicate it. Price was going down. If you draw a simple line, right? See swings. Swing, swing, not going to make it, right? Swing, swing. We just changed. Boom. A simple line will also tell you this. Right? We were going this way. Now we're not going that way anymore. Alright. And we're about that length. Now here's how you can combine gaps and swings when it comes to thinking about a trade in here. So as you get here and you're watching price, you might be thinking, alright, there's a possibility to capture this swing. And now we can use gaps even as an entry technique on a smaller scale. We have a gap up, wide range bar, bigger than the last 3 bars. So this is one way I would use this as an entry technique and get stops underneath. So on and so forth, because price swings. And so that's mapping a market and seeing the swing. And again, once you start to make new highs, what happens? Price swings. If you're reading this via median line, right, we hit the median line, we come back. We hit the median line, we come back. We test it a little bit. We hit the median line, we come back. Now we're on this side. And even here, we can see it's a different kind of a trade. But if you understand this, it can help you manage positions as well. We have another gap. We have a gap here as well. Now we've crossed the line. And we're off to the next line. And that's the end of the week. So that was this market with swings and gaps. It's just a wave. New high, swing back, and this guy extended. So you can begin to take these markets apart. You know how to mark out gaps, you know how to mark out swings. So at the end of the week, when things are calm, there's no trading, go back and do a little review, and these simple methods will begin to teach you. Do a review using gaps, using swings, and see what your markets did. And this way you get the learning in your own bones rather than just the instructions.